Good afternoon and welcome to today's webinar. Thank you everyone for being here. My name is Judy Murphy and I'm with the M&A Club. It is truly a pleasure to welcome you here today. Before we get started, I'm going to share a few details about the M&A Club for anyone who is attending one of our events for the first time. The M&A Club of Canada was founded in 2009, and it's the country's largest membership-based network dedicated to mergers and acquisitions professionals. So we organize events such as monthly roundtable meetings in the different chapters across the country, but also webinars like the one you're attending today. The goal is really to bring together professionals from M&A, private equity, and financing to share expertise and build relationships. We're present across the country in cities such as Toronto, Montreal, Vancouver, Edmonton, Calgary, Ottawa, and Quebec City, and we'll be opening in Winnipeg and Halifax in 2026. On to the webinar of today now. So today's webinar is called Data Analytics for Due Diligence, as you can see on the screen. It is presented to you by Sapling Financial Consultants. They're going to be talking about how data analytics can elevate the due diligence process. We're going to take questions at the end, but feel free to ask your questions during the webinar, but please use the Q&A button that is down at the bottom of your screen. We will answer them at the end. So without further ado, I will pass it over to our speakers, Stefan Mioc and Ali Rezai from Sapling Financial Consultants. Enjoy.
Judy. Thanks everyone for joining us today. Like Judy said, my name is Stefan Mioc, and today we're going to be talking about data analytics for due diligence. So just a bit of background on me. I'm a senior engagement manager here at Sapling Financial Consultants. Been here 6 months now, coming up on 6 months. And prior to my time at Sapling, I was at Grant Thornton in the M&A transactions team. So I'll just let Ali as well do a quick intro.
Hello, everyone. My name is Ali, and I've been a consultant at Sapling for about 2.5 years, with a focus on data analytics and statistical analysis.
Perfect. Next slide there, Ali. So today we'll start off with the agenda. We'll go through a little bit about Sapling. Then Ali will get into kind of an overview of what we'll be talking about. He'll take you through a couple case studies and then some final thoughts, and then save the Q&A for the end. Next slide. So just on this slide, our motto is, we live for A+, and that's because we aim for nothing less than, the top tier and top quality work that our clients expect. But the big thing is that, we expect this from ourselves as a professional services firm. But overall, Sapling Financial Consultants is a boutique financials consultancy firm, and we specialize in financial modeling, data analytics, and due diligence for the mid-market sector. A little bit about, the geography where we operate in and some industries we operate in. As you can see on the screen here, we're fairly industry agnostic, performing services for our clients in, healthcare, energy, tech, professional services, and manufacturing, and so on. In terms of our revenue split across North America, we're primarily, 75% of our fees come from the States. We deal with a lot of private equity firms in the States, but also in Canada, and we're trying to get that a little bit more even moving forward. In terms of, our locations, our headquarters is in Toronto and North York, and we just opened a satellite office in Atlanta recently as well. Next slide, please. Go. So this is just, I'll spend about a minute here just talking about a service offering. But really there's, three pillars, and fourth, if you consider the time-based services that we have. But first one being there is due diligence, of course. We do both buy-side and sell-side due diligence services, commercial due diligence, and then, data analytics with due diligence services. We also have a financial planning and analysis arm, and it's kind of the modeling pillar of our business. And these services include, financial model builds, Excel reporting packs for FP&A purposes, operating tool enhancements, as well as valuations work. And kind of the third pillar we have there is our data analytics and digital transformation practice. So this includes both, business intelligence and dashboarding, automation, and IT optimization services. And then we have time-based services. The first one being their interim FP&A. You could think of this as, outsourced CFO type work. And then we also have, outsourced corp dev associate, where we help a lot of our, PE firms that are looking to purchase new companies as well. Next slide, please. I won't go into too much detail here. We will be circulating this presentation, after the webinar, but this is just an examples of, successful deals we've worked on in terms of, both sell side and buy side QOVs. The next slide is the same as well. And then, I'll pass it off to Ali to take us through the rest of the webinar.
All right. Thank you. We'll start with some introduction and overview. We'll go over 2 of our case studies and we'll finish it off with some final words. Now, I just want to talk a little bit about the importance of in M&A. Typically, whenever we go make a purchase, even a small purchase, we'll ask ourselves a set of questions about the price of the item we want to buy, the quality of the item, compare the price. We'll ask, will this item be still good in a month, in a year, in 10 years? Can I sell this item, etc. And as the stakes goes higher, the extent of these questions increases as well and goes higher. And this allows us to really validate our choices and validates what we're going for, uncover risks, and build confidence. So in order to go out and buy a company, there are different types of due diligence that recommended to perform. And here we have some of the common types of due diligence that are happening in high stakes situations. For example, financial quality of earning due diligence, where it validates your company's financials, the accounting, making sure the numbers are indeed shown as expected. IT due diligence, assessing the IT infrastructure and the scalability of the IT infrastructure. Contracts and obligations, to understand, does the company have any types of liabilities, commitments that the buyer needs to be aware of? Legal, certain company in certain industries might be subjected to certain regulations, and understanding those ahead of the deal helps you in order to assess the risks and the liabilities that might come with that. HR, to evaluate the workforce dynamics. The employees are ultimately or what propels any business to grow and to be able to increase its value. So it's good to understand how the dynamics there works. And ultimately, the main focus of today is data analytics for due diligence, which unlocks the insights into all aspects of the business, from financials to operation, HR, customers. And this could happen before the deal, during the deal, which could impact the valuation of the deal, and ultimately after the deal. So we'll focus on the data analytics side of things for due diligence for today. So what does data analytic add to a due diligence process? Typically, each company records their data. They're using different types of systems, their accounting systems, their ERP, but at most, those systems offer very superficial reporting to towards to the business, for the business. And even then, those type of reporting wouldn't really show all the insights that you would need for that company. What data analytics does is to look a couple levels deeper into just the superficial data you would receive from your typical accounting software, ERP softwares. So in a sense, it turns raw data, raw financial data, operational data into more of an actionable deal insights. And this process of data analytics tries to answer a set of questions. And we categorize them into four different types of questions. Questions such as, what happened in the business at certain points in the past, what happened, and these are more of a descriptive type of question. For example, and we have a set of questions here as well, like, are the reported revenue, margin, expenses consistent with the underlying data? You don't necessarily ask or why that happened. You just want to understand what happened in the past. You look at the historical data. You want to see the trends and all the associated things that happened throughout that time in the past. A level deeper into that piece, you want to ask a question: why did that specific thing happen? And that point, you start to diagnose exactly why, for example, our revenue started to grow suddenly previous period. And you can look into different types of factors that influence the revenue growth. Or questions like, are customer losses are due to the price, service, or just the competition in general? Well, by this point, you're still looking at all of your historical data. But in the next phase, the next type of question of where you ask what will happen next are those predictive questions that also data analytics is able to help to answer those. Questions like, how stable is recurring revenue for the future based on your repeated clients and subscription? Or what are the expected churn or retention rate going to be? And here you still look at your historical data, but you're trying to understand what will happen within the next couple of years. And you try to predict based on historical data. And a level deeper into the data analytics journey, you have your prescriptive questions that you're trying to answer. You could answer with data analytics. And those are, what should we do? And here, instead of just relying on the inputs from all the historical data that the company gathers, you are also adding certain variables into the questions. Things such as, how can cost structure be optimized post acquisition? Where are the cross sells opportunities or upsells opportunities? So these questions are not necessarily relying on the information that was within the company within the past few years, but also you need to have a set of your influence also becomes like, the company is going to do X, Y, and Z, and how would X, Y, and Z going to influence the sales, the numbers moving forward. So these are the four types of questions that data analytics tries to answer during the deal, prior to the deal, and even after the deal. And each of the companies that you would deal with, they are going to be in their own pathway and in their own maturity journey of the data analytics. Not all companies going to be advanced in this data analytics journey. And some companies may just be starting out. So here I have a graph where it shows the cycle of the data analytics and where the company might be and how can they proceed towards building a good data analytics suite for the entire company to be able to utilize and answer all the types of questions we posed in the previous slides. So it all starts really from the data foundations. If a company doesn't have the foundation to doesn't have the foundations, they are not able to really answer any types of the descriptive questions, the diagnostic, let alone the predictive or prescriptive. The data foundations are such as, are you using a proper software? Are you using your accounting software, your ERP properly? And um, in addition to that, do people within that organizations properly inputting the data? We see many cases where within a company, two salesmen are using the system completely differently, and it creates all sorts of inconsistency within data, and essentially makes data unusable. So having the proper data foundation process in place helps the company to utilize all the other aftermath of the of having that foundation. So that becomes that data management side of things, having your data consistent, standardized, centralized, helps to move to the next step, next phase of the data analytics maturity, which is essentially business intelligence. And within the business intelligence, you're able to perform operational reporting, KPI reporting, and some targeted analytics. And by doing so, you're essentially answering the descriptive questions as well as the diagnostic question, which majority of companies are starting to implement their business intelligence and having that suite of capabilities integrated within their companies. Now, moving forward, once the company is already set with their foundations and business intelligence capabilities, then we get to the advanced analytics, which will help them to respond to questions such as, what will happen next, and what can we do to influence that, to fix that, or to trigger something. That comes with the predictive analysis as well as the prescriptive analysis, and examples such as like future scenario planning, projection model, optimization model, and AI and machine learning models can be then integrated into the company. The mid market and the lower smaller businesses typically haven't gotten to a point of utilizing advanced analytics, but there are certain industries that advanced analytics have been dominant and had its influence have been undeniable. And you guys probably know the types of industries I'm talking about, where advanced analytics trying to make is influencing on every single decisions that is being made. But the key point is that each company is on its own path, and there are actions that each company is going to make. It's going to be slightly different than each other, as they are on their own path. And if a company necessarily doing KPI reporting, the next company might not even have the foundation, so they have to start earlier. But at the end of the day, understanding where they are is valuable in order to evolve through this journey. So having said that, having that not all companies might be in a good position in terms of where they are analytically. For you to as in this M&A space and deal making space, you may approach a company and they may not be on the side of on a developed side of the data analytics, and you still want to perform your data analytics due diligence on that company. So here comes more of a subset of the analytics, more targeted data analytics, which are very useful in M&A space, where a company might not have the great foundation for the data, but you as a buyer approach them, you could start to create a simple foundation just for like customer analytics or financial analytics, operational analytics, or people analytics, and run your analysis only on that subset, only for that targeted analytics that you're willing to do. For example, you could start to build a simple foundation and populate all the customer data and start running certain analysis, target analysis such as retention and churn analysis, cohort analysis, and customer retention. And we'll talk about a case study where we essentially perform similar thing only for the subset of the customer. We didn't need to integrate everything, but for the purpose of the deal, we just wanted to get a good sense of how their customers are reacting, the customer behavior, and how can what can the buyers do after the deal to improve any situations that might not have been ideal at the point. Similar thing, financial and analytics, revenue margin bridge, regression analysis, correlation analysis, scenario modeling. Not necessarily need the entire data foundation. Having that is obviously useful, but you could always run these target analysis based on a simple and a subset of the foundation. Operational analytics, you could work on their typical targeted analytics for that as well, like working capital trends, capacity utilization analysis, unit economics analysis, as well as typical some other people on analytics analysis, such as attrition and retention analysis, compensation benchmarking, and recurring cost efficiencies. These are more of the so all these types of analysis have been done. There are methodologies for them, and running them for a deal. You could run them on a subset of the data foundation, and still get the result that you would need for the deal, before the deal, during the deal, and later on after the deal, you could implement these type of analytics into the company's data maturity journey. So we're going to move on to our case study, the case study that we performed, the case study on the customer retention and cohort analytics. Our first case study will discuss one of our clients, a membership-based service company, which they wanted to understand and uncover a customer revenue detail concentration, as well as a true customer retention and lifetime value by using churn analytics. This specific company had some seasonalities in terms of their business they were offering, as well as some different customer acquisition pattern that we wanted to take those into account. So for these types of client analysis, where it's a deal in place, and they don't have necessarily all the foundational data they would need. We create a subset of data that is required for the data for the analysis. And based on that, we'll start to run different types of analysis. And the analysis usually starts at a high level. So on the step one for this client, we started to rank their customer by revenue. And as you can see, we ranked the top customers here, the associated revenue with each customer, just to get a sense of how much each customer brings in, and who are the top customers, and what is the concentration, what is the revenue concentration for each customers. It's important to always, with these type of targeted analytics, you start at the top and then go deeper into the roots of the changes, or you start at a very overview level, and as you go further, you start to go into more details in terms of what is causing different things that you would notice. So we started doing that, and in the next step, we start to look into the top customers and build a customer concentration analysis. And here we group the customers into the top 10 customers, top 11 to 20 customers, and the rest of the customers. We look at the billed hours they were billing and the revenue dollar per billed hours. And ultimately, we developed a concentration for the top customers concentration revenue percentages. And some of the things like we noticed, the top 10 customers from 2021, the revenue, the percentage of the allocated percentage was around 12%, but as the years increased, the top customers started to dominate the revenue percentage a lot more, to the point of 25%. So these were a couple of flags we wanted to like raise for the buyers to have a sense of where the majority of the revenue is coming from. So moving forward was in our third step, we started to do so since this client was a subscription-based company and there were a lot of retaining customer, we wanted to understand the customer behavior when they join, when they got churn, and at what point they'd be churned, and what are the reasons they'd be churned. So if you know a deal goes through and you want to improve the company or you want to influence improve certain processes, you could come back in here and try to understand the reasonings behind or at what point customers starts to leave and it starts to get out of their contract. So we started with cohorting the customers into different years and looked into the starting customer within each cohort and when they get added and when they get churned. And this goes through the age as they get mature with the company. So they started within a year, within a 1 month, 2 months, 3 months, when the big churn starts to happen. And for example, one thing in this analysis we noticed was that around a 5th month or 6th month, some customers start to leave, and that's a flag we wanted to understand a little bit deeper into that. We wanted to see why we have typically 2-3% churn rate across different ages, but at around 5 month, 6 month point, we start to see a big increase in terms of the churn rate. So that was like in the starting point for us to start our step 4 analysis. And in step 4, we started to develop this fall chart for the customer cohort retention, where instead of having our cohort be different years, we started to have our cohort for different months. So if a customer started October 22, they'd be categorized under October 22. If the customer started in November 22, they'd be categorized under the cohort of November 22. And we start to see, and we have the number of customers, and we developed this tool in a Power BI dashboard so then they could drill into seeing exactly which customer at what point they leave and why they left the company. So as you can see, we see the retention of them throughout the months, and for example, here we notice there are around 5 months and 6 months, the retention goes below 75% and 65%. And for example, this May 2023 might be one case where the client could drill down and understand why the customer started to leave around 6 months. What was the reason they start to leave? And maybe they could reach out to the customer and understand the reasoning a little bit better. Having the customer service approach them and see why they left, and was there anything that the company would have been able to do to prevent customers to leave. So that was part of the customer. That was a part of the analysis to understand the customer's behavior a little bit more, and to help and in general, like you want to understand the numbers a little bit better. So if a company had a couple months of good revenue in, that doesn't necessarily translate to much of the consistent revenue over time. So having that understanding, like for example, when customers leaves and are you able to acquire customers with ease and keep them, helps you long term understand if revenue is coming in consistently. And in our last step, we performed a more complex analysis to understand the customer a lifetime value, how much each customer is going to bring us money over the time of their over the duration of their stay with the company. And we performed this analysis both over time as well as over different services. So we performed this over time just to understand at which point customers that join at which point bring us most amount of money. And you know, there is some trends here. We noticed that you know, customers that typically signed January through March as well as October through December typically stay with the company and bring a lot more money compared to customers that join over summer. So that's one starting point to dig a little bit further and understand why why we're seeing such trend. Or when we did the analysis by time. But also, I mean, we did the analysis by different product type to understand what type of product type and services that the companies offer actually brings the most amount of money. So necessarily price isn't the indication of you know, the higher the price of the product is, the more money that product brings. But the duration that people going to use that product is going to influence how much in totality the customer brings money to the company. And we look at it across different services, and we also overlaid with the churn rate that each service had to kind of get a sense of, you know, if there is something that could be done in terms of the churn to help increase the revenue that each product line brings in. So overall, these are more of the tools where it could be used after the deal, and also before the deal to understand what are we're looking at this company. This company, there are a lot of rooms to grow. There might be a little bit undervalued right now, but we could, with a bit of improvement on some of these items, we could essentially grow this company a lot soon and a lot more. That was the analysis that we performed on customers for this client, this service-based client that we had. In the next case study, I'm going to talk about the sales transaction, analysis on the sales transaction for this US-based private equity firm to identify the drivers behind sales growth across customer segments and uncover underlying performance pattern. So, you know, not all growth is equal. Sometimes you know, they're growth, but they're not sustainable, or they're just a one-off due to the market situation, and it may not be as reliable to pay heavy money on them. So our goal was to isolate the structural growth from the one-off and the one-time or cyclical effects. And just like the previous analysis, we started at the top level. We just wanted to get a sense of how things are, and we created such graph like this to just see the sales volume trend and the overall trend line. We'll see some seasonality exist for the sales volume, but the general trend has been like an upward trend. We also did an analysis under sales concentration, which at the beginning, the sales concentration was mainly for 82% was for the top customers, but over time they started to balance out their top customers and also like the non-top customers to a point of 64 to the 36%. And such information might be might be, having your top customers bringing the most money might be good for some industries, but might not be good for other industries. So the context of it is always important. Now, in the next step, once we had some understanding, we wanted to understand. This client identified certain factors that influence their sales volume. And we redacted the actual factors, and we have like factor 1 through 10. And we did the correlation analysis to understand how these factors influence each other. We see, for example, like factor 3 alongside with factor 2 probably has high influence when working together, or factor 9 and factor 10, they also have like high influence when they're working together. So we look at this correlation analysis, and based on this, we can start to dig into the more detail of why factor 9 alongside factor 10 impacts our cells, and why some factors we have like a negative correlation. What can we do? Why that's happening, and what can we do to influence that? So we perform a correlation analysis in our step 2. And in a step 3, we perform a regression analysis to understand the impact of each factor impacting the cells. So here we have factors such as marketing spend, store traffic, discount rate, competitor price, seasonality index, and customer rating. And before we were looking at does each factor interact with each other, but here we just wanted to understand does each factor impact the cells, and how each factor impact the cells. And for example, we see like the customer rating is one of those factors where it impacts the cells pretty significantly in comparison to for example, competitor price. And these numbers are as good as the data that comes in, and it's clean. It's always good to point out that the data that the company records is always one of the most important assets, where it enables all these type of analysis to be performed, and ultimately impacts the final performance of the company. Now, after performing the regression and the correlation analysis, we have some sense of different factors and how they react and how they influence the cells. We started to look into more specific factors in more details. So we began by investigating one of the factors, which was like a price change rate year over year, to see does the price change impact sales performance. So meaning the product they were selling, was there an outlier in terms of did the price just went up significantly that caused an increase in sales, or did the price went down that significantly, price of the item went down significantly to influence the sales. And we plot this graph where it shows the year-over-year price change. We have it for 2017 and 2018, where majority of the price changes were within that 0% to negative 2.5%. So not the biggest changes. So not major influence in terms of the price change. We have some more significant changes in price, but they are very limited, and we see the bulk of the price changes in the items were within that negative 2.5% and 0%. So that's one factor that we looked into, and we kind of got a sense that the price change might have not had much of an influence in terms of the changes in sales. And one conclusion might have been just like having the price to be staying consistent might have caused the sales to grow as well. And in next step, we also looked into another specific factor in a bit more detail. And here we investigated the wage per revenue for different services across different regions for this specific company. And for example, we noticed like service 3, the service 3 offering usually have a very good wage per revenue percentages, whereas Service 6, the wage per revenue percentages are pretty high. And this could cause, understanding such information will end up being used as like, do we need to reconsider some of the process we are doing for Service 6? Do we even need to keep the Service 6? And such an analysis alongside, for example, the customer, some of those customer analysis together could lead to some restructuring in the services that's being offered. So if a service is not is not performing well, maybe it needs to be adjusted, reconfigure, or rethink of generally. This was the end of this engagement, and we performed some analysis to understand their sales volume, why certain trends are happening, and what are the specific factors that impacts the sales volume over time in a bit more structured way than technical way with some backing of the data behind it. As for some final words, we want to say like the data analytics is really one of those pieces where it's may not seem necessary, but the impact of it is really essential before the deal, during the deal, and definitely after the deal. It guides a smarter decision, uncovers hidden opportunities, and identify risk. Many times, the superficial informations that are available may not be enough to really make a confident decision. But performing data, some data analytics works, performing some targeted analytics ultimately leads to have that confidence in decision making. As I mentioned, every company is on its own analytic maturity path, evolving from descriptive to predictive and insights. And it's important to evaluate where the company is and act based on that. Sometimes certain types of analytics might not be possible, but there might be other solution that could be used to perform such analysis. So it's always good to evaluate where the company is in terms of their data analytics maturity. And ultimately, in due diligence, analytics provides clarity behind the surface. And this is something I try to mention a lot. It reveals both promising area and potential red flags, which were unseen that could shape long-term value. And this is important. Sometimes we always focus on like the red flags, but there might be areas where it's underutilized within a company, and performing such data analytics might help you get some company, might help you this M&A space get some companies with a lot of opportunities and with a lot of growth ahead of them. May not that even the CEO and executive of the said company might not be aware of the opportunities lays in their company. And lastly, the true data analytics doesn't really stop at the numbers. It starts with understanding what the numbers means in respect to the business. So business by business, industry by industry, numbers may represent different things, and it's always good to give some context to what entails certain numbers and analytics. With that, I think we can go to the questions and see if there are any questions to answers.
Hi everyone, it's time to ask your question. Please use the option Q&A at the bottom of your screen to write your question.
No one seems to have a question. Oh, here's a question. Ali or Stefan, are you able to see it?
Yep. So what's the depth and breadth of your HR analytics? We do have a, we look at the, um, for one, we look at the, how long the employees work, how long the employee stays over time, and we build similar stuff that we had for like the customer retention. We could build the employee retention. We can look into the compensation analysis, benchmarking against other roles within the similar industries. That entails part of those HR analytics. And depending on the nature of the business and nature of the work, could look into more of the performance of the employees and the efficiency of the employees. Is there any areas that being handled that could be automated, for example, or if it's more of an factory type of work, is everything is there any is there any loss in terms of the employee time that could be avoided, or is there any employee inefficiencies happening as a result of the way things are structured? It could be looked at several different aspects, from retention of the employees to the compensation of the employees and to the overall efficiencies of employees within that business.
Are there any other questions? Here we go. You have another one. Do you see it, Ali?
Yeah. So these items for HR analytics, is there a correlation to something as to why you selected them? Not necessarily. I think we've noticed we performed some of those employee retention analysis before, and in terms of we had models already done for like the employee compensations and how the compensation and models that could be used to moderate the compensation. But in general, I think the goal ultimately for the analytics is to understand the areas that are there to grow for the company, and some of these are like if you are gonna go after a company and buy that company and there are constant retention problem, you can definitely like growing that company might not be as easy as might be very difficult. So understanding like historically how the employee retention has been working is part of that, where it helps you. Do I if I go out there and buy this company, do I have enough workforce to even grow this company, or am I just going to constantly worry about replacing my employees? Or the other side of things is always the cost side of things. Am I overpaying or am I underpaying? Is that causing some of those retention problems? I think ultimately we were trying to tailor the types of analysis towards the growth of the company, and we'll try to logic it based on how the execs are looking at it and how the buyers wanted to look at it and wanted to perform the company. So that's how we usually try to tailor each of these analytics towards the goal of ultimately helping the company to grow, and understand the value of that company.
Thank you. You have another question that is, has workforce or leadership data ever led you to renegotiate deal terms or adjust integration strategy?
Stefan, maybe you could chime in as well on this.
don't represent clients from a, an M&A perspective. Like we focus on the deep of it. Like we can flag that through our analytics. If there's, cultural misalignment or high turnover in a business unit, we'll highlight that. It's up to essentially the buyer to figure out a system to, have proper integration, post close. And we do help them with that, but I wouldn't say, we would renegotiate any terms on behalf of anyone. That's kind of not in our wheelhouse, but we do support from, a higher level. I don't know if you have anything to add to that, Ali, but.
Great. Thank you so much. Last call for questions. See if anybody has any last questions before we wrap it up. I think that's about it. Thank you so much to both of you for being here, and thank you to all of the attendees. Hopefully you found it useful, and have a great rest of your day.
Thanks a lot, everyone.
Thank you so much. Bye, everyone.
Bye.